Well, good morning, everybody. It is April 27th. This is Wall Street Beats. Bob Morris, Charlie Peabody, David Maris here, kind of the triumvirate, the Mount Rushmore of Wall Street Beats. And I can say that because we're here and the others aren't. So I feel safe in saying that. We're going to talk about some some financials. I don't know, Death Star, Magastar, something. I don't know what it was. It sounded frightening. But first, let's talk about some oil and gas. I know EQT reported last week, Bob. Thanks for that. What say you on the oil and gas names? And what's the story with the new? Are we opening the Straits of Hormuz, or are they're planning on it? What's the most recent update?
It not surprisingly, any sort of deal seems still far off. And as we've said all along, I think Iran's strategy is to stall, buy time, and not in any way give in on their nuclear ambitions. And so what they said is, oh yeah, we'll open the Strait of Hormuz if you end the blockade, but yeah, and then later, we'll talk about all this nuclear stuff down the road, which is, I think, a non-starter for the Trump administration. And like we've said all along, they're going to go fighting tooth and nail before they give up their nuclear ambition. And I think part of the main part of their strategy is to stall, hoping that at some point the Trump administration gets political pushback, whether it's domestically from the opposing party or internationally from other countries, if they try to go back to a more aggressive posture in trying to back Iran down. And who knows, at one point or twice, I guess now, Trump's threatened to blow up all their power plants and bridges and such, and backed off at the 11th hour. But we're still in this sort of no man's land where they're not anywhere close to reaching a deal, and in that Iran's not offering up what the Trump administration wants, which number one on the list is giving up their nuclear ambition. So I think we're continuing to sort of tread water here, literally. Strait of Hormuz, I think the U.S. maintains the blockade to put economic pressure on Iran, which seems to be working. And in the meantime, Iran's going to push back by trying to blockade any movement of ships or that aren't, of their inkling from going to the Strait of Hormuz. And so as a result, oil's up again this morning, up slightly. WTI, I think, is $96 a barrel. And I think that we sort of hang in here in this $90 to $100 per barrel range. In the meantime, that could continue to creep higher over time if this blockade and shutdown of the Strait of Hormuz for all effective purposes remains in place. So for the oil names, we're sticking with them here. The key thing is we're about to kick off, or we did kick off earnings last week with EQT and Range Resources. We were on the call ahead of EQT reporting, saying that we were above the high end of the range on consensus for both production and earnings, and they did come in and slightly beat even our estimate. So it was a very good quarter for EQT. The stock's up since then, and we would continue to be holders of EQT. Again, EQT and EXC, Expand Energy, are two main holdings on natural gas or natural gas leverage here. And in the meantime, natural gas, what we talked about last week too, down here around 260 for the near month. I think that's sort of near a low for the year. We're in this shoulder period still where there's really no big heating or cooling load demand. So once we start to get into the summer and start to see some weather, I really don't see natural gas prices going a lot lower. And we've talked a lot about the long-term fundamentals, how those are very strong, very positive for natural gas. So the natural gas names have become more interesting to me here. And again, we talked about EQT last week and the fact that we would continue to be owners of that name, particularly on the good earnings that they reported.
All right. So CNQ should put up a monster quarter and give us a special dividend. Is that right?
I don't think we're going to get a special dividend out of them this quarter, but this week, what we're looking forward to is Chevron and Exxon toward the end of the week. Chevron on Friday. Chevron's one of our core holdings. We also own Exxon. But I think overall on earnings, you're going to see on average beats, just given I don't think the market has fully incorporated the higher oil prices that were experienced in the first quarter. So I think EQT was sort of a little bit of an exception, and they were a very strong beat. But I expect on average moderate beats by the sector as we go through earnings here.
All right. Well, sounds good. I'm a happy holder of those. So
you should be very happy on C&Q.
I am happy on. I am happy on
50% on that one.
Yeah, something like that. So, the problem with if you're a sector specialist, you own a lot of what you're used to, what you know. And so when you buy oil and gas, when you're a healthcare person, you don't buy it in enough size. Then when this happens, you're never happy. I think investing is about never being happy. Like you never own enough of the things that are doing well, and you're miserable about the things that are underperforming. So yes, I'm happy in my own limited capacity to be happy about them. So
that's why you have to be a long-term investor. You can't always pick the bottoms, and you can't always pick the tops. So
yeah, I think.
Sorry.
So I was going to say, I think we've all talked about it offline of how our biggest gains really are things that we haven't tried to day trade because none of us are really particularly good at that. So, but Charlie, you were saying something?
Yeah, speak for yourself. I've been a big believer in the energy trade and I'm overweighted energy. But when you in EQT, I get it. But honestly, Bob, when you look at it 6 months or 1 year, it's really gone nowhere. So we've had nice rallies, so from January to April there was a nice rally, but what's going to sustain a rally here?
Yeah, so it's what we've talked about. A lot of people have talked about the long-term fundamentals with the demand that's going to come in from AI power generation in these data centers, LNG exports as more LNG export capacity comes online starting later this year in the U.S., which right now has got to fill a big gap from what's been taken offline from Qatar and the Middle East. So the fundamentals is really starting, particularly, I think, in the second half of this year. The demand for natural gas is very strong. Now, in the meantime, yes, storage inventories are higher than a year ago, which is why nat gas is down here around 260 today. And the biggest factor we can't predict is weather. And so while we had a little bit warmer than normal winter, that sort of kept storage levels at elevated levels here coming into the summer. But the fundamentals continue to be very strong long term. And, that's why you kind of have to pick your spots on some of these gas names. I mean, we're up on EQT and Expand Energy, but they're up. I'm looking at the 1 year chart or the 6 month chart. They're up over the last 6 months, but it's been very volatile, from a high here of, 68 to a low of just under 50. So yeah, it's very volatile. That's why you kind of have to pick your spots. And like last week, Ben was hosting and mentioned, well, would you write $55 puts on EQT? And I said, yeah, if that's the way you want to play it, yeah, ahead of earnings, rather than buying it, if you want to just, sell puts to collect that premium, you can do it that way, which was a good trade. But what gets it moving, to your question, Charlie, is just, I think still the long-term fundamentals for natural gas are very strong, particularly with what this AI demand build-out is going to be. And EQT is playing that very well. They're sort of on the forefront of taking advantage of that, trying to meet that demand.
And then in terms of oil, we're in backwardation. You look out to the December contract, we're under $80.
Yeah.
It seems to me that the deliveries that are occurring from those ships that made it through the Strait before the war started are hitting their ports now. But then we've got 3, 4, 5 month lag where there's no new production. Storage facilities are full, so you can't. That's why you can't produce.
Yeah.
Do you sense that things are underpriced here in the oil markets, or?
You mean equities? I think equities, yes. I still think valuations are strong for equities, but the longer this goes on, the more that back end of the curve is going to move up. And if we look back here 2 weeks ago, we were at 73, 74 on the December contract. And now today on the December contract, we're at 78. January, we're at 77. So that continues to move up. You're still in backwardation, but the back end of the curve continues to kind of tick up. the longer this goes on, the longer we stay far away from having any sort of agreement. So yes, the longer this goes on, the tighter things are going to get. One thing you have seen that's helped a little bit, you have seen some demand destruction, particularly in Europe, which has helped a little bit. But yeah, the longer this goes on, the more underpriced these things are going to be, because these companies every day are minting cash, so to speak, on, getting $95, $100 a barrel on their oil.
One of the reasons I was asking about that is because obviously the big news over the weekend and this week is that Kevin Warsh is likely now to be confirmed as the new Fed chairman, because Tillis, the DOJ dropped their suit against Powell, and Tillis, the senator from North Carolina, has decided not to block the nomination anymore. And obviously, a lot of people do believe that Warsh is Trump's sock puppet. Whether that's true or not, I don't know, but the world believes that, and that he's going to move towards lowering rates before year end. But if oil prices remain above $80, $85 a barrel, it's going to be tough to do that. And I was curious to see how December SOFR futures would trade, SOFR being secured overnight funding rate. And they've actually ticked down. They didn't rally over the weekend or today. So there's some skepticism in the markets that Warsh is going to be able to lower rates. But that's important, because I think part of the bid in the markets, and I only think it's part, is the expectation that Warsh is going to follow through with Trump's wishes.
Yeah, I think the employment data, though, kind of hasn't been so great. And with all the layoffs announced in the last week or two, I don't know if he's coming into the best environment to be raising rates or holding things steady. So I agree with you. I think you follow through on the promises of what got you to where whatever promises you had to make, implicit or otherwise. And I'm sure that he didn't promise anything. I do believe because he was in a recent interview where he said, "Look, I never said anything about that." But you don't select somebody that you think is going to go against your policy. And
don't confuse fundamentals with politics, Dave.
Yeah, well, that's what I mean. Is like, also he may not have said anything to him, but the vetting team he said a lot to. So there's lots of different ways to parse a sentence. But I think you could make, though, an argument economically that that's why I mentioned the employment, that listen, the oil is really just a temporary issue. The inflation that we're seeing isn't demand-driven inflation. This isn't prices going out of control. This is war related. So do you have a better, at least intellectual, argument for goosing things and lowering rates? So I don't know. You're the finance guy, so maybe.
No, you're right. I mean, that's the argument that Marin has been making, and that Warsh is going to make, and that is you have to look through the temporary inflation impact of this crisis. That's why I was asking Bob about the December contract. It's, as he pointed out, it's been inching up consistently here in the last couple of weeks, and I think we're going to have higher oil prices for longer. But that's the fundamentals, and then there's the politics, and the way you rationalize the politics is by saying, well, we're going to look through this as temporary, and then the other argument that's been sort of woven into this has been that AI is ultimately going to be a great productivity enhancer, and therefore we don't have to worry about long-term inflation. So I do suspect at some point by the end of this year we will see an attempt to lower rates.
Mm-hmm. All right. So now you wanted to talk about the Death Star or something related to the new Star Wars Mandalorian and Grogu movie, I think, or something related to that.
You're close. Anytime you're talking about financials, you're talking about Death Stars.
All right. So
I'm going to talk about Flagstar.
Flagstar. Okay.
Symbol FLG, Frank, Larry, George. And Justin, if you can put up the chart. So just to remind you, this is a name I've mentioned several times in the recent past. It's a bank that is a turnaround candidate, and turnarounds in banking industry are very difficult to execute on. They lost money for 2 years in a row, but turned profitable in the fourth quarter. And then on Friday reported their first quarter earnings and were profitable again. They earned about 3 cents, reported 4 cents at core. Management. Well, the core story here is they got caught in a real estate debacle. This bank almost failed, and now they're trying to work through those real estate problem assets. And I have heard from the banking industry twice now, in the fourth quarter and again here in the first quarter, that real estate is finally moving. It's clearing. And for the first time, I think even Bank of America said for the first time, they didn't have a single commercial real estate credit inflow into their criticized asset bucket. So we're starting to see clearing prices. We're starting to see some stability and even improvement depending on who you're talking about. And that's a good backdrop for this type of bank to have a turnaround situation. They, as I said, they earned about 4 cents core in the first quarter. If you look at the top right line, you'll see they're projecting, this is the company's projections, that they can earn 60 to 65 cents this year. I'm a little skeptical of that. And they did lower, their estimates from what they thought they could earn, at the beginning of the year. But it's not so much the level of earnings, it's the fact that they actually are now profitable after losing money for 2 years. Because if they can sustain the profits by removing, problem commercial real estate assets from the book at close to par, and that's key, is removing these problem assets at close to par or where they're reserved for, then they can remain profitable and grow that tangible book value. And tangible book value is somewhere around, it's actually stated it's around $17.42, but adjusted for potential dilution from warrants, it's closer to the $16 level. And the stock trades around 13 and change. And I think the longer that they can prove that that book value is real by remaining profitable, this stock is going to trade up towards tangible book. And then as you look towards the second half of the year, their capital position has improved dramatically. They've got a CET1 ratio. If you look at the bottom right, that's the regulatory capital requirements. That's their goal, is to bring their CET ratio down to 10.5 to 11.5%. It's currently 13.2%. So they have about $1.6 billion of excess capital right now. Obviously, they want to keep some of that just in case the commercial real estate issues don't resolve positively. But I think in the second half of this year, you're going to start to see them buy back stock fairly aggressively. And since you're buying back stock at a discount to tangible book, it's very accretive. And so you start growing book more rapidly, not just through retained earnings. So I like this story as a turnaround candidate. There are a number of different levers. One, obviously, the biggest one is working down the commercial real estate problems. But if you look at the top left, the net interest margin, that net interest margin is around, in the recent quarter around 215. There's tremendous leverage if they can improve their margin, and there are a number of ways in which they're going to improve that margin. One is lower their funding costs, because they had to lock in a lot of expensive long-term funding, when they were in trouble, because they needed, to secure their liquidity. They're starting to replace the runoff of their commercial real estate loans with some very attractive corporate lending, C&I. There is obviously, the more you reduce the non-accrual loans, which are not earning assets, and replace them with earning assets, that helps your margin. And then they have a number of multifamily loans that are resetting higher. So that margin expansion is where the real leverage is going to come from when you're talking about a company that's a turnaround candidate.
So when you go, how do you go from like a 4 cent or a nickel a quarter to, I don't know, 25 cents a quarter?
Well, you don't. And that's why I said, I think the 60, 65 cents is probably a little aggressive. And they did lower that by a nickel. They put out a forecast at the beginning of this year of 65 to 70. Now they're at 60 to 65. Probably will go down another nickel next quarter. But the level of earnings is not the driver here.
That's what I was going to get at. Is I mean, wouldn't they be better off just saying, look, we're going to do 30 cents this year and $1 next year, and then beat those numbers, rather than, hey, we're making great progress, but we keep disappointing on the EPS side.
Yeah, I mean, you're right. It's better to beat than not, but I'm not going to get caught up in the level of earnings at this stage of a turnaround. I'm more interested in can they remain profitable and grow that tangible book value, and can they work their problem assets off at par? In other words, if they have to work the problem assets by writing them down and taking big, provisions, that's not a good way to work down, because that works against growing your tangible book value. But so I'm not going to get caught up in the earnings forecast as much as I am in can they remain profitable, and I think they can. And the efficiency ratio, if you look again at the top right, the efficiency ratio of 70 to 75%, that's unusually high. Efficiency ratio is how much of your revenues are being eaten up by expenses. And that's unusually high at 70, 75%. It actually was 80 or 90% this past quarter. And so they have a lot of room to lower their expense structure. And that's the other part of the leverage. So there are lots of different levers for earnings improvement. And that's kind of what they're trying to depict by putting out a 60-cent number is margin improvement, lower efficiency ratios are two of the biggest levers to generate an earnings acceleration story. But turnarounds are difficult in this industry, and they take longer than most people expect. But I do like the fact that they're profitable and that they have excess capital, which is going to allow them to buy back stock. So the stock did sell off after they reported earnings. That's been sort of typical of how this stock has acted. It's run up into earnings and then sold off after because they miss on their earnings expectations. So I would use this pullback as an opportunity to buy it.
Got it. All right. Anything else for you today? That's a new name for me. I've not heard of it before, so I'm gonna look into that a little bit more. I did look into this little bank called Connect One, which I think I mentioned it a couple years ago, where the CEO is a former construction guy, and he said when he couldn't find a bank that would work with him, he started his own, and that always sounded kind of like a little fishy to me. And but the stock's done really, really well. So this small regional bank in New Jersey has actually done a couple little deals, like little local banks that they've purchased. So
I'll just mention one other name. I haven't finished the work on it, but I'm doing work on it. It's called Essex. It's a REIT, ESS. Edward Sam is the symbol. As I said, if you listen to the bank, earnings reports from January and again here in April, one of the things that is really coming through very solidly is the belief that the worst on the commercial real estate front has passed. Now, that doesn't mean it's going to be a great asset to invest in. It's just that the write-downs have occurred, at least in the banking industry. Clearing prices are being realized, and there are select pockets where things, can get better. The reason I'm taking a look at Essex is they are West Coast, primarily California and the state of Washington. Seattle and San Francisco are big concentrations for them. And they are in multifamily housing. And that's one of the areas, there's probably in 2 years' time going to be a shortage because of where starts are right now. It's got a 4% yield. They should do about $16 a share in funds from operations. So it's trading around 15, 16 times earnings. I mean, FFO. I think those areas are areas that are going to have a more extreme shortage than, let's say, Florida. I wouldn't want to buy apartments or multifamily housing in Florida or Texas, but I think the West Coast and the state of Washington are going to have a shortage. So that one is kind of intrigued. It's flat on its butt right now. Hasn't done much, but it's got a 4% plus yield. So I'm going to start to look at some of these REITs and see if there's opportunities in real estate.
All right, so ESS, keep an eye on that one as well. So just to go back to Bob, CNQ, it's up 70.48%. So not 50%. So I had to look to make sure. Just on the healthcare front, there are a couple of things. There was a deal to buy Organon by an Indian generic company called Sun Pharma. That's the big news for healthcare, is that this is a big generic player that's been trying to do stuff into brands lately, the last couple of years, doing some dermatology things, and they're doing actually pretty well with their brand execution. Most people would have bet against an Indian company trying to run a U.S. branded company, but they're doing okay with it. So this is a $10-11 billion acquisition of a spin out from Merck, and it's a big deal. So $10 billion deals don't make the news anymore that much, but an interesting trend to watch. Will these very large Indian generic players start to integrate? I've always said, back when I was a sell side analyst even, that generic drug companies want to be brand companies. They just want to move up the value chain. If you notice, like, the brand companies, they drive the nice cars, they have the better lawyers, they have everything their offices are better. Everything about them are better because they have higher margins. Higher margins attract attract a lot of fun things if you're a management team. So moving into the branded side is greater stability. You know where your meals are coming from because you're not chasing every new patent expiry. So it's not surprising to see that Sun Pharma stock is up too. I mean, it is surprising because usually when you pay for a deal, the acquirer's stock goes down a little bit, and but this one, it hasn't. Now, in the other side of deals, I didn't predict that one. I didn't have any skin in the game, so I can't be too happy about it. But XOMA, XOMA, royalty company that, if you recall, a couple of years ago, a year and a half ago, I brought it up. I also brought it up last November and December as something that I own. I even had a guest speaker on one time who was talking about Royalty Pharma, and this is kind of a smaller version of Royalty Pharma. This XOMA is a royalty company. They buy pieces of drugs that are going to market or being developed to help fund the companies that are doing it, and that the other companies don't have to keep the expense on their P&L. Well, they announced they're being taken out today. So happy about that, to wake up to a company I own being taken out. While CNQ is up 70%. Let's see where XOMA is.
Wait, what premium is the takeout at?
Pretty low, because it kind of was, the stock had run up into it. But so I want to say it was 12% or 15%, but let's see here. It's up 9% today, so whatever that was, probably like 13% if I know how ARBs work. So there's zero chance that this deal, I don't want to say zero chance. I think there's a high likelihood that this deal goes through, because it's a drug company buying them. There are no other bidders or anything like that. And the management team's participating in this, so it's not like they're against it or anything. So that's up 71%. So since I mentioned it when I bought it, so happy about that. We have Teva.
You're just making money hand over fist here, David.
Yeah, well, let's talk about some of the ones that I haven't. I don't talk about those that often. Remember I mentioned that Japanese mayonnaise company. Well, they're down 11% since I bought it. So look, I could go through a long list of those. One day I'll do that of just I shouldn't say a long list. It's not really that long. But Teva reports this week, and so does another company that I'm involved with. So let's talk about that. Teva, I sold a little bit of it, not going into the quarter. I sold it a little bit before that. The stock had hit the $34, $35 range that I thought was fair. I think that they're going to execute fine. I think the stock's been up the last few times they've reported. One time was up like 20%, one time was 5%. They've had a knock on wood, a good string of beating earnings. I think they're executing fine. I met with them at the Barclays conference a month ago, just to take the temperature. Everything seems like it's going well. And so If I owned it, I wouldn't try to trade around it. If anything, I'd want to own it into the quarter. But since I already do, I'm just going to leave it alone. There is another company though that that's reporting this week that I brought up before that could be a disaster, but it might not be. And so let's talk about that. But first, I do want to say for a small biotech company that's starting to kind of make some, start to move a little bit 4D molecular. Keep that one on the radar, because I'm probably going to just take the XOM profits and put it into that. I already own some, but I could own more. So Teladoc, I've written about it. I talked about it. They report this week, and if the cash flow is bad, well, the stock's going to get cut in half. If the cash flow is good, it could go up a lot, because then it could show that they have an out for this big debt that's coming due in a year from now. So keep an eye on that one. If I didn't own it at all, I probably would just wait till the quarter, miss the move and buy it with greater confidence. But I have a position already, and it's not a full position. So I do think that they're going to solve this debt issue, and I think they're going to get rid of BetterHelp, which is the part of the business that's not doing so well. And if they do, it should be a great stock. If cash flow isn't so great, it's going to be a horrible stock. So that's the risk. It's a triple to better, in my opinion, or zero. I don't think it's going to go bankrupt, but they are free cash flow positive, but it is pretty risky. So that's one that I'm willing to take that risk on. But with that, is there anything else we should talk about, guys?
David, on the risk that you mentioned, since it's so binary, would you sell some calls to fund buying some puts just to sort of hedge your position?
For the, it's not. Let's see what they traded today. It's pretty liquid though. So,
if you could be cash neutral on selling calls to fund the buying the puts.
I just don't know if it's going to be on the quarter that it would move that much. Again, if it's very strong cash flow, great. So this is a turnaround where the new CEO is like, we're making progress. That's such an easy story to be like, we're making progress, but this quarter was a little challenging because it's a turnaround. So I don't know if I'd want to take the time risk. It's a good idea though.
Yeah, and I don't know what the premiums would be. I haven't looked at it to see.
Yeah,
how out of the money you'd have to write the calls to fund puts. But anyway,
well, I looked last week. I looked at the $6 calls, and they weren't so bad. I want to say they were 50 cents, and you're at 5.85. So let's.
It's not much.
It sounds like a lot, but on a stock like this, it's really not.
It's such a low stock.
Let's see. Yeah, so it's 30 cents. So for the May ones, and that's a day out. So the decay is gigantic on something like that because you're May 1. So maybe you want to go out another week or two. So May 15th, still 37 cents for the $6. That's not bad at all. Mm-hmm. So maybe I'll do that. Maybe I'll augment my. But what were you saying, Charlie? You were muted when you said something. So
no, I was just curious. I know we're all sector specialists, but you might have views on the market. But do you believe in this rally, or does it not matter to you?
So we weren't on it all together before, but a couple of weeks ago or 3 weeks ago, I said that I put more money into the market, and so I guess that's saying I believe it. I'll also. I just don't believe that I'm very good or anyone's very good at timing the market. I don't know where else people are going to go. It's pretty tough right now. You could say that's, people are saying, oh, when people say go global, there, it's been outperforming, go international. I always go, okay, well, I'm okay. I own some international stocks, but I just, when that hype comes around, I'm usually batting down the hatches and saying I'm going to buy more U.S. So I know someone who recently came into a little bit of money from a gift, so a 7-figure amount, and they asked me what to do. Then they asked 2 other people that I know, one who's a multi-centimillionaire and who's advised by like Bessemer and others. And we all had the same advice. You know what? Can't really time it. Put 50% in the market, put 50% in bonds, and sleep at night. Someone had said 70-30 because they're in their like they're in their 40s, and that's a tough thing, right? Because the market has all this uncertainty around the war. Is it going to get worse? Is it going to get better? If it gets worse, right, temporarily things are going to be really bad again. But how bad is it right now? So am I a believer? I don't know, Bob. What about you? I just think we can't.
I'm still sitting on a larger than normal percentage of cash. Just sort of watching here. I mean, the market's still very bifurcated. Obviously, energy's done very well. Healthcare's been okay, but in some industrials have done well. But otherwise, consumer discretionary has been horrible. Tech's done really well. And that's largely what's been carrying the market higher here. But like you said, where would I go with excess cash right now? I don't know. I mean, I'm not buying healthcare. I'm not buying consumer discretionary. Maybe there might be something to do in industrials. I don't know. But the fact is, if there's some solution to the war tomorrow and the oil comes, down $10 a barrel, the market's going to rip up. So it's sort of hard, like you said, it's hard to time and predict exactly what direction all these variables go. But a lot of it, the fact that the markets continue to hold up here and hit new highs with oil where it's at has been very impressive.
Yep.
It's
I'm
like
sitting,
the market
I'm
it's
somewhere
like the
around
market almost
20.
doesn't care that oil's at $95 a barrel.
Yeah. I'm currently around 20% cash. So it's not a tremendous amount. It's more than I was 2 years ago, but it's not like I'm sitting on 50% cash. How about you, Charlie? Are you just all in?
No, I'm heavily underinvested. I'm 30-40% cash, depending which portfolio you're talking about. But so, listen, from my perspective, economically, the economy's fine as long as this, CapEx spending boom by the hyperscalers continues. And the consumer is going to continue to spend as long as equities remain elevated because of the positive wealth effect. But if you lose 1 or 2 of those things, I think we're in a recession. And, I'm worried about, a recession by the end of the year because I'm having a hard time with the equity valuations and the likely negative impact it could have on the wealth effect, because that upper end consumer is really what's keeping the spending going. And if we have any kind of correction in equities, that upper end is going to feel it more so than anybody else. And real estate has been the other source of value for the upper end. And we've now had 2 quarters in a row where real estate values have ticked down very, very modestly, but it's no longer a wealth creator. So if we lose the equities as a wealth creator, then that upper end is going to stop spending. Now, what would cause equities to correct and stay down? Something obviously in the Middle East that creates higher oil prices would be the first thing that comes to mind.
By the way, just so that we help our viewers here, when I talk about cash, I include in cash treasuries. Some people don't. They consider that fixed income. They consider it bonds. How do you consider it when you're talking about you're sitting on cash? Do you literally mean like, yeah, it's a money market fund, I'm getting whatever 2.5%, 3% or whatever number that is now, or do you consider like treasuries as cash?
I would not if it's in excess of 2 years. I mean, I own TUA. TUA is the 2-year treasury, but no, I don't own any significant positions in long bonds, and I would not consider that cash.
I mean,
Yes,
I don't. I'm like Charlie. I don't consider long bonds cash, but I'm not considering this. I've got treasuries laddered out over the next year every month, but I'm not considering that cash.
So that's what I consider. By the way, that's what I consider cash, just because, they're short term and I can sell them in a minute. And I mean, maybe not a minute because I'm not that fast, but I could sell them right away in their cash. But okay, just so that, so
Yeah,
I'm even less in cash then. So then you get that impression.
I point out too, at the same time that I'm above average in my cash position, I'm also a little bit above average in hedging, in writing covered calls on some of the more volatile names that are up a lot. So, as far as hedging my position, I'm a little bit more hedged in that regard than I normally am too. So, we'll see here. A little nervous about significant upside, but I'm not worried about a market crash either. But when I have an opportunity, like I've said before, to sell vol on something that makes sense that's up, then I'm doing that too. Probably a little bit more than normal.
All right. So two cautious optimists. One, I can't say not cautious. I'm cautious, but in a different way. But all right, so let's wrap it up today.
I'm a cautious pessimist.
Yeah, that's what I was gonna. When I said you're an optimist, I was gonna say that's not really true. So a cautious pessimist, a cautious optimist, and then somebody somewhere, some outlier. I don't know on how I call myself, but this is Wall Street Beats. You should go to wallstreetbeats.com and sign up if you're listening to this, because you already got so much value. Sign up for a subscription, or go to passes.com/wallstreetbeats. You can sign up there too. And we look forward to seeing you the next time tomorrow. This is Wall Street Beats for Bob Morris, Charlie Peabody. I'm David Maris.